Hi. A very good afternoon to everyone. So, right before I start this session alone, I would hope that Pius has cleared out some of the confusion around bonds, around Malaysia market bonds. But my job for the next 15 minutes or so is to reconfuse you with the second half Malaysia bond outlook. So, but before that, one of the up and front questions that we may have in our mind is, why Malaysia bond market? What is so special and appealing about Malaysia bond market that should make us bet an eye on it? So the answers actually lies in the table behind me. So if you look at the year 2013 and 2022 itself, we can see that Malaysia bond indexes has registered positive return, while the other bond indexes have registered negative returns. This is made possible by the composition of Malaysia bond market participants. So if I give you an example, if you look at the outstanding MGS holders, and you can see that from this table itself, 79% of them are actually domestic holders, with the likes of EPF, banking institutions, KWNP, and much more. And what these big institutions tend to do with their sizable holdings is that they tend to deploy buy and hold strategy, which effectively reduces the overall volatility of Malaysia bond market. So just a very quick recap on why we look at Malaysia bond market. Two keywords. One is the resiliencies of it. Secondly is the stability that it provides us. So if we look back to the current Malaysia bond market space, what we are seeing currently is that the credit spread is tightening around Malaysia bond space. So just to clarify, what is credit spread tightening to the ground? Credit spread tightening basically means that the yield differential between two different credit rated bonds are shrinking. So if we look at this chart itself, taking AA and A1 as an example, we can see that the differences from 5-year average used to be 13.3, but then we currently seeing it at around 6.4%, which the differential is quite huge. So some of the dynamics that are in play that causes this credit spread tightening is actually the slightly lower bond issuances in first half of 2024, as well as the high concentration of new bond issuances in the high investment grade region, particularly in AAA and AA region. And this is coupled with the high volume of bonds maturing in 2024, which exacerbated the whole credit spread tightening situation in Malaysia. So if you look at one of the most important aspects when it comes to investing in Malaysia bond market is inflation. So looking at this chart alone, we can see that the latest inflation data shows that Malaysia's CPI has inched up to 2%. And if we take into account of the recently implemented diesel subsidy rationalization, as well as the upcoming RON 95 subsidy rationalization, we can expect that inflation rate will go even higher from here. Okay, but then if we look at the Malaysia government inflation target for 2024 itself, they have set a very wide inflation target of 2% to 3.5% for this year alone, just to account for any knee-jerk reaction from the subsidy rationalization. Hence, this leads us to our view that OPR will remain unchanged for the rest of this year. This is due to the moderate inflation rate as aforementioned, as well as the largely sideways ringgit movement that we've seen currently. And this is also coupled with the huge interest rate differential that we see between OPR rate and Fed fund rate that is amount to close to 235 basis point differential. Now here comes the most important slides in my presentation. So what we are expecting for the remainder of the year is that we expect Malaysia bonds to trade range bound for the rest of the year due to the absence of stimulus. And unlike bond markets in the SGD and the AUD spaces, and as well as the USD spaces, Malaysia bond market actually offers a reasonable steepness that makes extending duration sensible. Hence, we will advocate investors to go on longer durations, such as 5 to 7 years, to take advantage of the value given by extending the durations. But we also wouldn't want to go beyond 7 years, just to take on any unnecessary risks like government political risks or any future economic development risks. And we also prefer corporate bond over MGS for their yield spread up, and particularly recommend investors to go for the lower end of the investment grade region, like the A1 and the A2 spaces for their substantial spread. So if you look at the chart here, we can see that the yield differential between AA1 and A1 is actually 108 basis points. So this means that if you buy into a AA1 bond, 5-year AA1 bond, you're actually losing out around 1% compared to investors who look into a 5-year A1 bonds. But the caveat when it comes to here is that you have to be picky and selective with A1 names, since we have been seeing some of the credit events happening in Malaysia bond market recently. So here are some of the recommended bonds from our internal research team based on the availability itself. So you can see that we have DRB Highcomb at 3.7% as well as CIMB Group at 3.9%. But then there would be a question. You will ask me, where is the 5% yield that you have been promising me from the previous slide itself? So, but sadly to say, we have not been seeing much A1 bond new issuances in Malaysia bond market, and the secondary market in the Malaysia bond market itself has been very dry. Hence, we couldn't really source A1 bond markets currently. But what we would like to advocate for today for investors is to learn about Malaysia bond market, embody the correct investment view, and then pounce on the opportunities when there is new A1 credit issuances. Alternatively, Malaysia bond investors can actually look beyond Malaysia bond market just to get more yield pickup from international bonds like USD and AUD bond space. So, but the caveat here is there is the risk of MYR appreciating, which we have been seeing recently as well. So, but as long as investors go for those USD or AUD bonds with enough yield buffer to offset any risk of MYR appreciating, we think that this won't be that much of an effect to your whole bond portfolio itself. So if you look at the recommendations that we have curated in the international bond market space itself, there is some household names like HSBC holdings at 5.6% in the AUD space, and Goodyear Tire and Rubber Company in the AUD space with 6% yield to maturity. So particularly in the USD space itself, 6% to 6.1%, we think that there is enough yield buffer to offset any potential MYR appreciation in the future. Now, just a very quick recap before I conclude my sharing today. For MYR bond market, go for 5 to 7 years and go for lower end of the investment grade. But the caveat is to be very picky and selective with the names. As for the international bond market, go for those with enough yield buffer so that it offsets any potential MYR appreciation. So that pretty much sums up what I want to share. And if you miss out on any of the discussion points just now, or if you like to revisit the recommended bonds, feel free to scan the QR code here that would provide the link to our bond outlook article that we've written recently. So that's pretty much from me, and happy investing.